Also with me are our speakers for today. We've got Annie Liu, Regional Head of Singapore and China of Data at Nasdaq, Annie. And we've got Anthony Chan, CEO of Isola Capital. We've got Grace Chu, MD, Sales and Business Development Asia of Direction Asia. And we have William Goh, Portfolio Manager, Asian Fixed Income at HSBC Asset Management. Well, before we begin, could we have each speaker do a brief introduction of themselves, maybe starting from Annie?
Hello, everyone. I'm Annie from Nasdaq and manage the Nasdaq data business in Singapore and China.
Good afternoon, everybody. I'm Anthony from Isola Capital. We're an asset management platform that tries to provide best-in-class risk-adjusted returns across the key asset classes. Looking forward to sharing with my fellow panelists this afternoon across all these ideas.
Good afternoon, everyone. My name is Grace. I'm from Direction. And Direction is among the leading leverage inverse ETF companies in the world. So far, we are kind of in the top 2 of leverage inverse ETF issuer in the world.
Hello, everyone. My name is William. I'm from HSBC Asset Management. We have 2 funds on the platform for everyone to choose from, and they are either managed by ourselves or our colleagues in other offices. Thank you.
And I thought I'll introduce myself as well. I'm Tian Tian. I'm a radio presenter with Money FM 89.3, and I present your financial news on the evening show from 4 to 7 p.m. Well, without further ado, let's take everyone through the flow of the conversation. So we'll start off by looking at the role of fixed income in a higher yield world, the rise of tactical and thematic strategies through ETFs, the growing influence of private markets, as well as how technology and data are reshaping access to global investment opportunities. So maybe let's start the conversation with Anthony and William. With the macro backdrop and the investor sentiment right now, how would you describe the current global macroeconomic landscape with a broad overview? What are the key growth expectations, inflation pressures, and interest rate trends you're seeing across the board?
Yeah, maybe I'll start first, and William, you can follow. I think as you heard from the last panel, I think the most dramatic impact that's happened since the beginning of this year with the new US administration is uncertainty. So that uncertainty is driving even greater volatility than we would normally experience. So if you think about the last black swan we had with COVID, it lasted way longer than most people expected. But now what we're envisaging and what we're experiencing is actually daily uncertainty and volatility. So I think that's the first thematic I would talk about. And that thematic impacts across all the key asset classes, whether it's equities, public or private, fixed income, which I think William will speak more about, and then some of the other asset classes that I think you'll hear about later today, which is in digital assets and real-world assets. So maybe to just think about the context, a lot of the news that drives the volatility today is actually also being leveraged by AI technology. So a lot of the professional asset managers, whether they're hedge funds or large asset allocators, all the way through to ETFs, are scraping information, and they're using technology to guide them in terms of how they trade the news flow. So I think a lot of the investors here today, mainly retail investors, but even for high net worth and more sophisticated investors, we need to be aware that sometimes it's about understanding information and interpreting that information with professionals, right, that help you understand the impact of how that information will affect, whether it's the flows, the pricing, and the environment. So I think, Tintin, you mentioned a little bit about whether it's inflation. I think right now, obviously, we're seeing the US dollar go through a bit of a depreciating effect against a lot of the major currencies around the world. And we probably haven't seen such a dramatic drop since the Plaza Accord about 40 years ago. So this is also something that we need to be aware of, right? That will affect the flows into different asset classes. So I think what I'm trying to get at is, as you look across investing, it's not about the specific stock or just whether it's equities or fixed income. There's a lot of other macro factors that drive this, including, I think on the fixed income side, interest rates. So I'll hand that over to William to explain.
Yeah, just a few quick comments. One of the things that we always try to get correct and what clients always ask us is, when is the Federal Reserve going to resume cutting rates again? They already cut 100 basis points previously from the peak. But if you get this question correct, you can get everything more or less correct: equities or bonds or FX, commodities. So our house view on the asset management side of HSBC is between 2 to 4 cuts of 25 basis points each in the next 12 months. And the first one coming as soon as September. So they have 4 meetings left in this year. The next one is July, probably nothing to be done. And then the next one, September, probably a 25 basis points cut. And just quickly on the Federal Reserve, the biggest central bank in the world, they do have a dual mandate: unemployment and inflation, which is what Anthony mentioned about. So both sides are giving the Federal Reserve problems. So to see what they do and how much they do, right, we need to get this right. And one of the ways that they can still cut rates, support unemployment or rather employment in the economy, and still pin down inflation is that, remember, unlike Singapore, in the US, the long end, the 30-year bonds decide your mortgage rates. So if that part of the long end continues to be high while the front end continues to come down, then where is the correct place to be? I guess the front end of the curve is a good place to be if you want the capital appreciation and the safety without the volatility. Yeah.
I'd like to go to Annie for this question. Coming in from Nasdaq's perspective, what is Nasdaq's outlook for the stock market in the second half of the year, and how is retail investor sentiment correspondingly?
Okay, I can share some latest research from our research team. In the second half of 2025, the world economy is showing a mix of steady strength and adjustment. The stock markets have been showing the very strong, which helping to drive the economy growth. In fact, whenever the total value of the stock markets goes up 10%, compared with the company's whole GDP, it leads to 0.028% increase in long-term economy growth. Then let's look at the retail perspective. How retail investors matter. Our research shows countries like US, Sweden, and Australia have the most households own stocks. It not only makes the stock market busier, it also boosts the overall value. According to Goldman Sachs, when more people in a country invest to the local stock market, it tends to goes up. The total market value tends to goes up. This makes it cheaper for the companies to raise money in the local market and encourage company to list it on the stock market. And there is also very interesting sentiment from the retail investors. Nasdaq, we have a data set can show the most liquidity stocks which retail investor trade. In the past 2 years, this top 10 list is quite stable. 2 of them from the 2 most liquidity ETF, and also 7 of them from the Magnificent 7. But recently, this top 10 list changed a little bit. The 2 ETFs still the most liquid ETFs. However, there are only 5 stocks from the Magnificent 7. I checked the list yesterday. 1 US online company on the list and 1 US cryptocurrency company on the list. So this is a very interesting data set, can show the retail investors' preference on the US stock markets.
And going to you, Grace, I'd like to get your take on this in terms of your observations. What do you think, from flows and product activity, where are investors really positioning themselves in light of macro uncertainty? Where are they parking their money?
Yeah, from our observation, it is a very interesting trend because probably everyone knows leverage inverse ETF are short-term trading tool, definitely are not for buy and hold. So in the during the market volatility, actually we see more short-term trading, and investors are doing more like a high-frequency trading, especially trading on headlines, such as tackle trade, opportunities trade, volatility trades, or swing trade. For example, this trend also reflect in let's take the trading volume as a sample. For example, the leverage ETF tracking semiconductor index, the trading volume hit the record high in April. It's 5 to 6 times of the average trading volume. That's really very crazy. And in terms of the cash inflow, year to date, especially from April, we've seen significant cash inflow into like semiconductor leverage inverse ETF, Tesla, and some big technology, stock related leverage inverse ETF. So in summary, we see that investor nowadays, individual investors actually are more active, when they are facing market volatility. Actually, they are taking more active actions by they want to catch up some short-term opportunity, for example, market rally, or they also can use many different kinds of trading instruments to hedge the portfolio by themselves.
So Grace, you've talked about hedging, you've talked about, I believe I heard Tesla as well, semiconductor ETFs, but really we started this conversation talking about the 60-40 strategy and how it has been put to the test right now in an uncertain environment. So if I could pose this question to you, William, in a multi-asset context then, how much allocation to fixed income makes sense today for both conservative and also growth-oriented investors?
Yeah, thanks, Tian Tian. First of all, 60-40, meaning 60 equities, 40 bonds, very popular, I would say, across the world. This kind of allocation has been tried and tested. And I do not have a perfect or an ideal split between bonds and equities or any other alternatives that you might want to. But I would say this, right? All of you manage your own portfolio of stocks, bonds, funds. I manage a portfolio of bonds. Now, let us think back and ask ourselves, right, in your entire journey, what are the 3 best stocks or bonds or funds that you have bought? How much did it make? Is it 100%? Did it triple in price, 50% or 10% up, right? And then let's be honest with ourselves. Did you, when you first bought in, did you expect the stock to go up 50%, to go up 100%? Or did we just hold on and then it went up anyway, right? So this is a question, as someone who do this as a career, I ask myself every time. I buy a bond, it goes up in price. Was it something I expected? Did my research show that it will go up in price? Or was I just lucky? Did Trump say something that helped me, right? So we don't want a kind of consistent strategy, and I would recommend this to everyone, is that you don't want to be subject to luck, whether good or bad luck, right? Similarly, if you had a bond or a stock that went down 50% in value, right? Were you really expecting it to go down 50%, or were you just unlucky? We don't really know most of the time. And that's where diversification comes in, that 60-40, right? And if you had diversified well, diversified good enough, different countries, different sectors, different asset classes, and you have spread out your bets wide enough, right? At any point of time, most of the time, not the whole entire portfolio will be going down or going up. So let's say today, like bonds go up, stocks go down, then you can rebalance, and you can set some like discipline within yourself every month end, every quarter end, every year end. Then you can do the rebalance yourself. So all these, before you go in and buy anything, have that discipline, set all these boundaries and limits for yourself, and time and stick to the discipline. Then you will do well, no matter what your allocation is. Thank you.
And going to, Grace, you talked about ETFs. So how do you see leverage ETF strategies fitting into long-term diversification plans then?
Sure. The role of leverage and inverse ETF is getting more and more important in the portfolio constructing or portfolio diversification. As everyone knows, leverage and inverse are like a short-term tactical trading tool. This kind of tool are very easy for investors to use to quickly adapt to markets, market volatility or market opportunity. For example, people use leverage ETF to capture some short-term like a market rally opportunity, and people can use inverse ETF to hedge the portfolio, or when investors have bearish views on some market or asset. And leverage inverse ETF trade on stock exchange, so they are trading like stock. Investors don't need a margin account to trade this kind of instrument. So it's quite easy and very straightforward to trade. For example, hey, I am positive in US market. You can find some like leverage ETF tracking some US market sector, or like a market cap index to kind of amplify the potential short-term return. And if you are really bearish or kind of negative, in the, for example, US market, definitely you can use inverse one. So I believe everyone in your portfolio, there are two different kind of investment pool. One is that so-called core investment, and the other is satellite investment. And I believe 70 or 80% of your money should be in the core investment. For example, in fixed income, some value stock, or some bonds, something like that. It's for like a long-term, mid-term, long-term investment. But it's so important to keep some satellite investment instrument. For example, what happened in this early April when the stock market or the US Treasury bond price dropped down or plunged suddenly. At least there are some like tactical or short-term trading instrument that you can use for like a short-term hedging, or you want to capture some short-term market or asset rally opportunities.
And I do want to hop on one of the points you mentioned when it comes to hedging, and this question is for Anthony. Let's talk a bit more about private assets then. In what ways do private assets help hedge against public market volatility? What should investors be mindful of, though, when accessing these opportunities? And also, what are some trends you're picking up from the ultra-high net worth and family office clients then?
Sure. Maybe let's talk about what private equity really can be bifurcated into. You've got earlier stage, which is venture capital. So you hear about very early stage companies that are seed, pre-A, ABC. You probably heard of all these terminologies. This is when the company has a concept, they're trying to raise capital to commercialize it, and then they get it to the point where they've got enough profitability that they might decide to either sell to a strategic or get listed. So one of the things that we always forget is the listed companies that you're looking at, that universe of 3,000, 4,000, 5,000 stocks, all of them started as a private company first. Now, at the other end of the spectrum, you may have heard of private equity buyouts. These are the very large private equity transactions where private equity funds privatize these companies. So at some point in their journey as a listed company, there may be a consolidation in the industry, or there may be something happening dramatically that the private equity investors see an opportunity to take private these companies, either to consolidate them, to vertically integrate them, horizontally integrate them, so that they get even bigger, right, and move on to the next stage of their lives. And then finally, we're now seeing a phenomenon, especially over the last 6, 7 years, and this is an important one to understand, where venture companies get so big in their valuation that they don't actually have a real exit in the public market. So there's a particular company called ByteDance, TikTok. They are at such a large valuation that they've explored options, for example, probably to look at the listing. So a lot of the investors in that would be institutional investors, family office investors, pension funds. So they've had the ability to access that type of investment, but their problem now is they don't necessarily have an exit. So going back to some of the earlier points that we discussed, how is it important and why is it important to have a diversification of the portfolio? The key consideration is liquidity, right? When you buy instruments or securities that the underlying has a liquid secondary market, so like shares, like bonds, like a lot of the structured products that we talked about, you know that you have a way to get liquidity quickly when you need the cash. So unfortunately, in the world of wealth, the richer you are, the more flexibility you have for allocation and diversification. Because maybe when you're still early in your wealth journey, you need to keep a larger proportion of your portfolio liquid, because you don't know, right? At any point in time, you might need capital, you need money to fund something. You need to have your portfolio be able to deliver you that liquidity. So to Tian Tian's point, for the families that have significant wealth, so whether they're first-generation family offices or multi-generational wealth, they have the flexibility because they have enough liquidity to maintain their lifestyle. They start exploring asset classes that provide higher returns. So normally, there is a relationship between liquidity and performance. But it's normally only for the top quartile funds, right? So just because normally private equity or venture capital can potentially give you a very high return because you have a longer period of illiquidity, doesn't mean that all private equity and all venture capital is going to give you that performance. Just like in stocks, you have to look for the best performers, the blue chips. And in the context of private alternatives, you normally are looking for fund managers that are top 25%, so what we call top quartile, consistently in terms of how they execute their strategy. So some of the things that we're seeing in the market which may be relevant for you as you guys grow along your wealth journey is there's more and more access now being made available for investors. So mainly through fund-of-fund structures or some sort of derivative structure where you will start being able to buy a little bit of exposure to some of this high-performing, less liquid investment strategies in private equity, venture capital, and private credit.
Yeah, and we've talked a lot about new strategies that investors can adopt and rebalancing of portfolio. And speaking of which, Annie, if I may go to you, how are tech and data tools now helping investors rebalance or reallocating portfolios more effectively, particularly during periods of higher market volatility?
First of all, I want to say I'm really happy to join those retail client events because we can easily got the opportunity to communicate with the retail investor directly. Based on my experience to communicate with the retail investors, I figured out there are two typical types of retail investors. One of them, they really believe Warren Buffett value investment. They buy a stock, they keep for a long time. The other types of retail investors, they are looking for the intraday trading opportunities. However, for the intraday trading opportunities, it's quite challenging because what stock you're going to buy, what is the right timing, what is the right price. So there is a very helpful data site on moomoo mobile app named Nasdaq Total View. It is the really valuable tool for all the retail investors to facilitate such kind of trading preference. I can give you an example how it works. Normally on the trading mobile app, there is a function named top gainer or top loser. There is a stock list. So which is about which company is performing the best or which company perform the worst at the given time. So you can just select one stock you're quite interesting, click into the code page and scroll down. You will find the depths of order book. You will find the Nasdaq Total View. There will be 60 levels, bid orders and ask orders. Normally, from the order size would be like 1 share, 10 shares, 100 shares. But if you suddenly figure out there is like 10 shares in the order book, you should be suddenly sensitive about it could be a trading opportunity because we call those orders like big orders compared with other size of the orders. The big orders is likely to make the price goes up or goes down very soon. So that would be a really good tool for the investors to use for your such kind of trading preference. My colleagues in Sherbo will have a presentation at the side stage at 5 p.m. in terms of how Nasdaq Total View can benefit the retail investors' investment decision. It would be a really insightful session, so welcome everyone to join that session. And also, we prepare some little fancy gifts for the Q&A session.
And Annie, if I could just stay with you for a bit, the Nasdaq is working towards 24 hours trading, 5 days a week. Why is this a game changer for investors, particularly those in Asia?
Yeah, for the 24 hours trading, right. Yes, Nasdaq, we already announced to launch the 24 hours trading in the second half of 2026. So why this change happening? The main reason is about the increasingly requirement globally, especially from the Asia. I can show you some numbers. As of June 2024, foreign investors held 17 trillion US dollars on US stock market, which is 97% increase since 2019. In South Korea, US stock ownership reached 100 billion US dollars on US stock market, which is 64% increase compared with previous year. Over the past 5 years, there were 56 exchange-traded products tracking to Nasdaq 100 launched globally. However, 98% of those products launched outside of US. So those numbers can show the increasingly strong requirement globally for the US stock market. What would be the benefit for the investors after the launch? First of all, for example, maybe for the retail investors in Singapore, you no longer have to wait until 4 p.m. or 9:30 p.m. To trade on the US stock market. You could just trade in your daytime. Another advantage is you could immediately react to the events, to the news, no matter if it's economic data, the political news, or even the earning reports. You can just trade on your daytime. And the third one is about it could benefit to the cross-market opportunities. For example, if the Apple stock suddenly moves, it could affect some Asian companies which is on the Apple's supply chain. Then you could quickly spot on those related opportunities in your local market. So those are all the benefits. And also, of course, higher liquidity and more trading volumes. Of course, apart from those benefits, there are also some challenges in front of us. Because when we launch the 24-hour trading, it's not just the exchange need to be ready. There are a lot of stakeholders in the industry also need to be ready, like the regulator and the SAP, DTCC, and even the listing companies. In fact, half of the listing companies, they are kind of concerned about the 24-hour trading because if 24-hour trading launch, they have to wake in their middle night, US time, to handling on some like urgent cases, maybe happening in Asia. So that would be a very big challenge for them. No matter what kind of challenge in front of it, but we really believe that there will be a lot of benefits for the whole markets.
I see, and I'm very mindful of the time as well. We've got about 7 minutes to go, and we have 12 questions now coming in. So just one quick question for all our panelists before we move on to the Q&A, and that is, we've talked a lot about strategies. We've talked a lot about how tech can enable more effective calibration of our portfolios, but really when it comes down to the overlooked opportunities, right? What are some overlooked opportunities and bright spots that investors, retail investors in particular, should tap to build a diversified portfolio in today's world? Maybe we could start with Grace, Anthony, and William.
Yeah, so from our observation, I think leverage inverse ETF, as I mentioned and repeat, is very important. It's like short-term trading opportunities, short-term trading tools. So we see strong interest, especially from individual investors, especially in, for example, like a semiconductor, like big technology names such as like NVIDIA, Tesla. And recently, especially this year, we also see strong interest in like a gold or gold miner. And that's very interesting because we found that several active traders, they like to use like a gold miner as also like a proxy to get, to get access to some gold trading, because we know like a gold mining company, actually stock price is much more volatile than the gold price. So that's interesting, very interesting trend. Also, we see more like a trade and interest on U.S. Treasury, either leverage or inverse side, because the increasing volatility in U.S. Treasury. At the end, we also see the interest in Hong Kong, China market, especially this year, compared since last September until now. So I think this is some observation from our side.
What about you, William?
Yeah, I think one of the easiest and most overlooked sectors or aspects of investing is what you do with your spare cash. And you want to place it somewhere safe and somewhere that gives you a higher yield as well, right? Rather than in your bank account. Say US dollar deposits, how much are you guys getting on your US dollar bank deposits? How many %? If you put it, for example, onto the moomoo platform, and you put it into one of those parking facilities, like there are some like short duration, ultra short duration funds out there, look at those, how much yields they are giving you. Easily over 4%, right? And it is good because you are getting paid to wait. And people say that, oh, equities market are expensive, this thing is expensive, and then you want to wait out in case there's volatility in summer and that's, but do not forgo the interest rates while you are waiting. So that's something that you can easily forget. Bring it back, get some yield on your capital while you wait. Thank you.
Yeah, and Anthony, before I get on to you, I think you'll be interested in these two Q&As that were, posed by the audience instead. And they are both generic and specific at the same time. And the first question is, top stocks in US ETFs have operations and revenues generated outside of the US. So what does it mean in deciding how we build a future-proof portfolio? That's the first one. The second question is, diversification has been mentioned a lot, but Warren Buffett has also cautioned against over-diversification. Which of these questions would you like to take?
For me, right?
Sure.
I'll take the second one.
Oh, you'll take the second question. Sure.
Yeah. So look, I think it's interesting and ironic that you're quoting that particular quote from Warren Buffett, because Warren Buffett also said to people, if you're just the average retail investor, just buy ETFs. So maybe I share a perspective which, obviously some of my fellow panelists will know even closer because you're at the exchange. I would say the majority of the trade flows on major market equities is right now actually hedge funds, right? It's institutional. And at the beginning, when I did the introduction, I don't know if you caught what I said, and I'll try and articulate in a much easier to understand way. The leading hedge funds in the world, right? The actual active investors are way ahead of the retail investor in terms of how they access news flow, how they interpret that news flow, how they're able to trade on that news flow. So even if you think you subscribe to all the relevant news wires and sources available, you are not going to be able to trade on that information faster than them, because their level of compute, right, whether it's algos that they have, the technology that they've implemented, the trunk cables they have directly to the exchange, they are trading at light speed, right? So the point I'm trying to make, if I bring it back to what Warren Buffett said before, he's not doubting the intellectual capacity of the retail investor or the resources you have available. It's just that the majority of the trading is done by those people who have way more resources than you, so they can trade faster than you, and they're analyzing that information faster than you. So how does that link back to ETFs? Now, ETFs, yes, very low cost way, but more importantly, ETFs are so diversified now, right? You can buy it by sector, by geography, by segmentation. So what that does, it gives you flexibility. Because what happens before we get to 24-hour trading, at the end of every trading day, the ETFs rebalance, right? So all the information's been traded during the daytime. At the end of the day, half an hour, 45 minutes before the end of the trading day, that ETF is going to rebalance the portfolio to match the different weightings of that portfolio. So unless you are a highly speculative active trader, you plan to stay up 24/7, it actually makes no sense for you to try and actively trade and beat the leading hedge funds. You can try, and you might succeed occasionally. So going back to the point Tian Tian was saying about diversification. Diversification doesn't stop you doing different investments into different asset classes. So whether it's public equities, public fixed income, right, bonds, doing structured products where the underlying are public equities and bonds, having some exposure to private equity, venture capital, private credit. Diversification means across asset classes. It also means that you should really be getting a little bit across geographies, because we now live in a world where it's multipolar, right? In the old days, it was very clear. US, totally the dominant capital markets in the world, right? And in this part of the world, in Asia, probably Hong Kong. But Europe as a whole, yes, but you can't really invest in Europe as a whole. That's why ETFs, right, and some of these fund managers that are offering product solutions are helping making it more efficient for you, because you don't want to be thinking about FX, right? I also mentioned in my introduction, you may or may not be aware, all the key currencies in the world have depreciated between 6 to 12% against the US dollar. I think the Sing dollar is probably up 6% itself. So if your basis for investing is Sing dollar, but you've put all your money into US dollar product solutions, you might actually be down because of the exchange rate. So having professional investors out there giving you solutions where they are thinking through not only diversification within the asset class, but across geographies, across sectors, and giving you access efficiently could be something you think about when you think about diversification in the portfolio. So it's not to stop you being an active trader yourself, but for you to allow yourself to do things in a much more efficient way and hopefully get a better outcome for your investment portfolio.
Oh, thank you so much, our panelists. I really wish we had slightly more time to just get some closing remarks, but unfortunately, we do have to wrap up. A big thank you to you for joining us in this conversation as well. Once again, we've got Annie Liu from NASDAQ. We have Anthony Chan from Isola Capital, Grace Chu from Direction Asia, and William Goh from HSBC Asset Management. Thank you so much, guys, for joining us today.